All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Interesting day in the market here so far. We have the Dow down about 20 points, so pretty nominal there on the Dow. But other indexes down a little bit more. We have the S&P, which we talked about earlier today, and it broke this morning's reaction low and shot on down. I made the comment, I would expect this 2790 area to be retested, and we got to 2791, and then we saw the market bounce about 20 points here and retrace the sell off that it saw earlier, and you can see all the action, and it's all within it's all within this week's action. Today's high and today's low did not make a new high or a new low on the week. Right, and so I know yes, we're talking about a 2830 down to 2790. We're talking about a 40-point move with a 20-point snapback, but it's not outside of the range. What is it? Well, it is increased volatility. It is increased average true range on the market. And generally in that environment, the path of least resistance is lower. But in that environment, the bounces can be pretty fierce. And, I expect that we're going to see a lot more of this. I don't think this is going away. In fact, I think this is only going to increase overall as the weeks and couple months come ahead, especially as we get into earnings season. So again, a lot of these principles are in play. When it comes to S&P futures, look, most of the time I don't care much about the level, and I know it's always everyone likes to look and go, well, this level's important and that level's important. The reality is most levels aren't that important, right? You think to yourself, well, if this level breaks, well, then what? It's easy to say, well, this level's important on the market, but then what, right? Oh, if it breaks, what's that mean? Oh, it could snap right on back, right? So there's not a lot of importance to levels mostly, but occasionally high volume levels have some significance. And that's really, as I kind of watch futures here this week and last week, where are the high volume points, that come into play? You can see the 20K volume that came into play right here, right? It tells you the market's not closing below this level today. The odds of the market closing below, and I know the market went a little bit lower in the short run, but the odds of the market closing below that level today are pretty much zero. I shouldn't say zero because it does happen occasionally, but it's very, very rare. It doesn't mean that the market can't sell back off down to this level, make a new low, and snap on back or something like that. It doesn't say the market can't go up 30 points, right? All it says is, hey, you know what? Chances of closing below this level are very slim. Can you make some day trades off that? Absolutely, right? Absolutely, and you can fire off some of those, buy something you really like for a day trade. And we're going to see a lot more of these come into the market, right? A lot more of these elements, will step in, and we will see this form as the market continues with some of its volatility. We're also going to see this principle of reaction high, reaction low come in. So when it comes to futures, these are the things I'm looking for. I'm not looking for this monster, well, this number breaks and yo-ho, we're bullish or we're bearish. Now, for me, it's about the metrics and, whether the market's sitting at 2820 or 2790, right? If the metrics are bearish, it tells me path of least resistance is going to be lower, right? The actual level doesn't really say anything, in that regard there. So anyway, we see stocks rebounding here this afternoon on some light volumes overall. There's a little volume in a few spaces, but overall light volumes, and still. We talked about this morning, this element of differentiation that's still out there, right? This isn't every fund manager just kind of jumping ship and having to bail and get on out of this market. There's still plenty of differentiation for the bulls to have, and they still do have that. Now, when we get into the chart, like on the Dow Jones here, you see this tail on it, right? Let's just assume the market's closing right now. And I know it has about 2 hours. But let's just assume the market's closing right now. And the market has this tail, right? What does that mean? It simply means that the market was down here today and rallied on back, right? That's all it means. But I want to kind of show you other tails that we have seen in the market. Here's a tail right here. Next day, went up. A couple days later, up. Then another down day with a big tail on it. And then rally. Tails must be pretty bullish, right? I mean, here we have a nice little tail. Market went up. Well, here we have a tail after a big bad down day. And market filled it. Right? Market filled it. Back here we have a tail. Market rallied. Right here we have a nice little tail. And down we go. Here we have a tail. Next day, down, up. Next day after that, up, then drop. Here we have a big tail, then pop. Here we have a big tail, small pop, drop. What's my point? My point is the tail doesn't mean anything. The tail absolutely means nothing. There's no real significance there with a tail on the market here today. And why would I say that? I mean, what comes into play there? Well, you can't say, well, the market's now bullish because it has a tail on it, right? Now, if it has this tail and then a gap up the next day, generally that's a bullish situation. Generally, when it has a tail on it today, the market gaps down the next day, it generally fills that tail or that shadow of the candle. In and of itself, the candle doesn't mean a whole lot. The candle says very little. But if it were to end this way, tomorrow's gap would mean a lot. If tomorrow, after ending, if things ended like this today, if tomorrow there's a gap up, chances are very, very high of continued market rally. If there's a gap down, the chances are almost certain that today's lows are going to at least be tested and generally broken. So in and of itself, I don't think we can look at today's candle and say, hey, you know what, this is bullish for the market or this is bearish for the market. But I do think it gives a really good insight into what could happen tomorrow if there's a gap. And by gap, I'm not talking about 2 points. I'm talking about something of significance, so something 0.3% or greater. That type of gap scenario. Now, there are still 2 hours left to go, right? We still have a market that could change its candle in a big way here before the close. And I apologize, there's a bunch of other stuff I'd like to show you, but stock charts today is on the fritz. It's one of those where it allows me to look at a couple charts and then it decides to kind of gimp out on me here, and here we go. So you can see the S&P, same type of scenario, same type of situation. You can see the tails on the market right back here in October, right? Okay, breaks on down, nice little tail, rally back into the close, everybody bullish, right? And the gaps, further, define the ultimate trend that is up and coming. Today, the market internals are unchanged, right? They're unchanged. There's just no difference in them from yesterday. The market vibe is still a 0, and it's it is all unchanged there, and so it's one of those where I don't read anything too different into the action out there. I was asked, since I can't make a challenge trade, lack of cash here, I'm pot committed here with Home Depot and EEM. Are there any trades I'm looking at personally and whatnot? And I've tried to show some of the ones I like the most, but FedEx is my favorite. I'm not in it yet. I'm not in it yet. As I mentioned earlier, 173 is kind of my point where I say, hey, all right, let's go, Jeff. Let's go get into this. I've had my eye on Alcoa today. A lot of these that kind of broke down a little bit yesterday. They're kind of holding up pretty well. A lot of these material names, so they really haven't given me a chance to jump on in. Halliburton, I like this one. Man, I was watching it today going, should I? But I like this kind of 3-day action that it's had because basically today's low breaks, down it goes. So 28.20, just like 137 for FedEx, Halliburton, 28.20, boom, there's my opportunity to go and to short it. I talked about J&J earlier. J&J's had a nice little clawback, nice little comeback here, trading up in the green. This is one where, we talked this morning, shot into a new high and failed, but also tried to sell off and is rallying on back. It sets up for a good risk reward. 138 stopping point, which is today's low, 138.07 to be exact, sets up for a really good risk reward to the upside, but probability of upside is only about 60%. Right? So if it goes, it's going to pay off, and the options will pay off and pay off nicely, but it's about a 60% chance. So it's a good risk reward, especially with the options. It's a probability that's kind of, middle ground there. But when you look at something like the 3 and the 7-day moving average, you have the 3 and the 7 crossing over in a very bullish fashion here today. So one of the charts out there today that you look at and say, all right, chances are, J&J, trades on higher. Now, can it defy the market? Can it trade, contrary to the market? It can. Johnson & Johnson is one of the few big Dow components that, can kind of march to the beat of its own drum. But, it's one of the reasons why the Dow is now green. The Dow Jones Industrial Average is now green. I mean, and you take a look at Apple today, helping to push the Dow higher. You take a look at Boeing helping to push the Dow higher. A very big reversal on Boeing here today as, they're basically Boeing went to Washington today. And so we're getting a lot of news and commentary about that and, some hopefulness that, the planes will be, able to be put back into commission without any dramatic issue and without any long-term negative ramifications associated there with it. But overall, my favorite plays in this market are simply market down plays. And I talked about it on Thursday last week after the Fed and after that big rally that we had. I went out and bought some SPY puts, bought some IWM put spread, and it kind of showed the longer term nature. August for the August in the money for the SPY puts, and July out of the money for the IWM spread. But those are my favorite plays out there. They're still my favorite plays out there. And it's one of the reasons why with the challenge, as I said, I'm going to go with an index and play this and let this trend emerge because it's going to be choppy. It's going to be bouncy. It's going to be one of those where everyone wants to make something out of a 20-point move. Ooh, what does this move mean? And, ooh, we gapped up and the market's green right now. What's that mean? Or, ooh, the market just had a sell-off. What's that mean? And most of that isn't going to have a lot to do with anything. Most of that's going to be the noise. But the overall metrics and trends are suggesting the downside element the risk of downside is significantly increased compared to what it has been, and higher than it's been at any time so far. So far this year. So those are my favorite plays, and I do like them over, some individual stock plays, but, again, I do think FedEx, UPS, that group, and, I've showed you the ones I like, mostly to the downside there. I still like gold a lot to the upside. I've been watching today's pullback. thinking, is this an opportunity? My biggest concern with gold has just been consolidation, right? And we've talked about the space and the AUYs of the world and the Barrick Golds of the world. And there's nothing too bearish in them today. This isn't a group where, I'm looking at it today and go, wow, something major's changing. It's still one of those where I go, okay, is it ready to really break out and move to the upside here just yet? Or are we in for just a little bit more consolidation? Well, on the GDX, we've put a high every single day this week at about 23.35, or just a little bit higher, 23.37. And, I think those highs break, and that's a pretty good sign that it's ready to, ready to move substantially. But it is the GDX. It can be quite volatile, and one that still has, heavy consolidation risk. But the volumes have been strongly bullish. The fundamental dynamics within the space continue to be very strongly bullish. I think it's one of those where, if you have a longer term time horizon, you buy on today's dip and you go for it. And you look to add if it dips a little bit more. If you have a really short term time horizon, you got to turn to your hourly chart. You have to look at something like an AUY and say, okay, here's the kind of, the pattern. Does it come back and revisit this 2260 level, and is that the entry point there for it? So the short term, I think, is still a lot more ambiguous and more consolidation risk with these names, but the long term, still very, very bullish element there. And I don't say that because I'm bearish on the market, and I just, I hope, I hope it's been made clear over the years that gold in the market, gold's not exactly a safe haven, right? If there's economic turmoil and chaos and the world implodes, people aren't going to be running around the street holding their gold bricks and shaving some off to buy a loaf of bread. Whiskey or liquor and tobacco and pharmaceuticals, they're all going to be worth way more than gold in an economic meltdown. Gold is a currency. Gold is an absolute currency and commodity in terms of demand for jewelry and other industrial processes. And so, it can beat to its own drum. It can occasionally be, you can see buying coming in from a safe haven standpoint, but it's controlled by central banks, run by central banks. Central banks drive it historically. And, the charts, the longer term charts, the shorter, the weekly, monthly type charts for gold are phenomenally bullish, and nothing really changing all too much there. Okay. So anyway, that's how I kind of look at things, here today, and some of the setups that I do like, and then this kind of tail concept that we're seeing, and could easily be erased by the end of the day, could easily be magnified by the end of the day with about 90 minutes left to go in today's trade. Okay. Last week I mentioned that this week we would be announcing about the Market Vibe and access to that, and in the new iteration of it, and that is coming. It was supposed to be ready this morning, but not quite there. And so I should be able to show it here tomorrow. And if you're hearing my voice, you will have free access to it. And, Michelle and support will be helping to take care of that. It also will have many past videos from Trader Minute on important topics like options and pricing and charting and timing and fundamentals and watch lists, and a whole bunch of some of the best videos from the years, all compiled in one place there, as well for anyone who wants to review those. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.